We've just held Argo's AGM, and now I'm joined by our Managing Director, Jason Beddow, who's going to discuss Australian shares, the broader economy, and also some specific questions we received during our meeting. Jason, not so long ago, aggressive interest rate rises had commentators almost universally dour in their outlook. They were predicting that spending would fall off a cliff, that house prices would plunge. Recession seemed almost inevitable. But to the surprise of many, Australia's economy has been incredibly resilient. What are the factors behind this resilience?
It's a good question, Meredith, and thank you. I guess if we go back to earlier this year, the world led by the US was going to be in recession by third or fourth quarter. What I think has surprised everyone is the resilience of the economy with the low unemployment in both the US and Australia. Fiscal spending, governments are still spending well above really their budgets, but that's supporting the economy. And I think interest rates, we forget about the other cohorts with the beneficiaries, people with savings and asset prices that are actually having a pay rise. They're earning more on their money. So savings rates were higher, and I guess maybe we're just delaying what will happen, but clearly everywhere in the world has held up better.
And to that end, the RBA has indicated that if inflation stays persistently high, that they are prepared to continue to raise rates. Could that be a tipping point for the economy?
It certainly makes the narrow path of getting it right, as in raising rates to stop inflation or reduce inflation and not cause a recession, harder. Also, it delays the next rate cut. People are already thinking forward to, okay, if we do hit a recession or we're getting near the peak of interest rates, that we'll get some relief. Now, that might be middle of next year or towards the end of next year. If the RBA indeed has to increase rates, that moment is well further out. And if there is just a delay in interest rates going up over the last year, that will be a harder point if we do hit it. So I think, the RBA would rather not put rates up. I think they will be dragged to raising rates if the data suggests they have to. But they are still stubbornly sticking to a 2% to 3% long-term inflation, and we are still above those metrics.
So challenging environment for central banks. Is it also a challenging investing environment?
Increasingly so. We're seeing that with share market volatility. As we just recently commented, this quarter or this financial year to date is, it's been pretty weak through August, September and October. Not a lot of guidance from companies. Liquidity is, I guess, coming out of the market, and we're seeing that in some of the smaller companies are really struggling, particularly from a share price perspective. So it's tricky.
So you're speaking to companies from across all areas of the economy on an almost daily basis. What are they telling you about trading conditions and specific to different sectors?
Generally speaking, though, the trading conditions are okay. It's a fairly broad term, okay. But they're not seeing, I guess, this precipitous cliff that they all expected to come. Some softening. We recently just commented, Woolies are seeing no real reduction, even though people are buying cheaper items off the shelf. House prices have been amazingly resilient and in fact have gone back up. That always gives people confidence. And unemployment, the rate's still 3.6%. If you want a job in Australia, you have a job. So if your assets are not falling and you have employment, you're still probably spending a little bit of money. And I think we're seeing that in the economy still. Now, does it run out? I guess that's the big question.
And any specific areas that you're seeing value at the moment? Where is Argo deploying its capital?
Again, it's a good question. We, I guess, medium term, we're still pretty confident or optimistic on commodities. We think decarbonisation is a massive event for the globe, and regardless of, I guess, the sexier commodities like lithium and rare earths, there's a lot of steel in a wind farm. There's a lot of steel in running transmission. And, for this to happen, commodity demand is going to be very, very strong. Energy is a tough one. On one hand, you've got the geopolitical tensions on energy, both in Russia, Ukraine and the Middle East, but a world that wants to move away from gas and oil. And that's a really challenging space, but I think these companies are going to earn good money, good cash flows the next few years. And health's the other interesting sector that used to be, I guess, the defensive quality sector. So when times were tough, people flocked to healthcare. And these stocks have had a real derating, whether it's been your devices like your ResMed, CSL, or the service providers like your Ramsay Private Hospitals or the pathology providers. And they're all on probably multi-year lows on a forward PE. So they look interesting, but equally, they've looked interesting, probably 10% above this from share price perspective.
Well, we might come back to some of the healthcare stocks in a moment, but a lot of Australians own the banks. What's your view, just broadly, on the Big Four?
Look, the Big Four are in pretty good shape. I mean, CBA reported in August, so I guess it's a couple of months ago now. Bad debts were minuscule, still fairly competitive for both deposits and mortgages, which is still, I guess, the key driver for the Aussie banks. But with house prices appreciating, which I think has probably been the other stat that people wouldn't have picked, the banks aren't under a lot of pressure. They've all got good balance sheets. They've all got excess capital. They're probably all going to increase their dividends and maybe even announce new buybacks. So it's sort of hardly the commentary you'd expect going into maybe a recession. I think there's some caution as we lead into 24 though, because I guess they are a leveraged play on the economy. If the economy has a hiccup, the banks will, have some impact.
So back to healthcare, and a new generation of weight loss drugs, notably Ozempic, has seen analysts extrapolating huge impacts on an economy-wide basis. What is your view on the impact from an Australian perspective, and are there any specific stocks? You touched on ResMed before.
Look, ResMed's probably the most obvious for us because, one, it's a big quality healthcare company. It's fallen really, really hard. And there is probably a direct correlation. Sleep apnea and obesity, definitely high correlation. And if less people are obese, there may be less treatment through a CPAP. But some of the commentary is outstanding. I mean, some of the companies that makes activewear, for example, are rallying because more people will be able to wear attractive activewear because they'll be skinnier. And look, I think it's really hard to make a call. I think clearly there'll be a benefit for people, but I think it's still too early to really tell the long-term impacts. Who's paying for this? The insurer's going to cover it. If you take it for 12 months, does it then have negative side effects on you, on your body, and then you have to go off it? So I think there's a lot of water under the bridge, but the market's pretty whippy. So the market's moving now, and I guess we'll know in time.
And to another hot topic being AI, and we'll just ask a question about it in the AGM and the impact on the Australian share market.
Again, there's not a lot of direct ways for us to invest in AI. There's probably a couple of small caps that talk about their AI capabilities. It's really the impact that big businesses will have embracing AI. Will they be able to reduce their costs significantly? Where back office is going to be wiped out. Does white collar employment come under a challenge? That's probably more interesting from us directly, not being able to invest or currently not investing offshore. So I think the likes of Nvidia and these other key names, we're not invested in. But like a lot of hype, there'll be a lot of blow off as well. There'll be, for every 100 companies that are involved in AI, there may be 10% that ultimately go on and become the Microsoft, the Googles, the Apples. There'll be a lot that fail. But between the environment and ESG, AI, the obesity drugs, not to mention geopolitics, there's plenty of different forces at the moment in the market.
And in terms of geopolitics, obviously we've got the war in Ukraine, but more recently tensions flaring in the Middle East. And in addition to the horrendous human cost, there are knock-on implications for Australia and the global economy. I was wondering if you could touch on those.
Look, I'm no geopolitical expert, and I guess Israel and its surrounding Palestinian neighbours have been at war for 50 years. If it's contained in that region, yes, it's a tragedy, but equally it probably doesn't have a lot to do with the global economy. If it spreads to Iran, Saudi Arabia, others, and the oil supply gets threatened, then that's a significant impact on an already very tight global energy market with, as you mentioned, Russia, Ukraine coming into a European winter. They may not be so lucky this time around with a warm winter. So I think it'll make markets very twitchy.
And staying overseas, turning to China, Australia's largest trading partner, and for some months now, there's been concern about the health of the Chinese economy. What's your perspective, and how and where are we seeing the impacts here?
Well, the impacts really in Australia are still pretty positive. I mean, China's still importing a lot of iron ore, and iron ore prices $110, $120. So with the weak Australian dollar, the big iron ore miners are making a lot of profits, which is great for them as a company and shareholders, but it's actually good for the country. They're huge taxpayers, and our budget's in surplus, which is extraordinary. Look, the economy's getting harder to read. President Xi has changed a lot of figures over the last few years. The way they report data has changed. I mean, it seems to be if it's a bad number, that stat is just not released anymore. Steel consumption still looks reasonable. They're still exporting a reasonable amount, but clearly there's a lot of pressure from the West, led by the US, on moving trade and supply lanes away from China. So there seems to be this, I guess, bigger fraction between, I guess, the BRICS, which is, I guess, the emerging nations, and the West. So China's definitely trying to trade more with the likes of India and Africa and some of the South American countries and Russia. So it's pretty challenging. But a lot of the tariffs directly impacting Australian companies actually have come off. So I guess the political environment, at least at a headline level, under the new government in Australia is better. And there's, I think, talk on the weekend that they're going to review the wine tariffs even, which would be positive for Treasury and Penfolds. So on the ground, it seems reasonable, but I think behind that, there's a lot of challenges. Youth unemployment's extremely high, property market's terrible, debt levels are rising, and there's a real, I think, tensions in that economy. So, and they're clearly not travelling as much as they were. So domestic travel, yes, and they clearly are travelling with opening of the economy. But if we look at the traffic numbers, they're still well down on pre-COVID. So whether people can't afford to, or there's less incentive for the Chinese, it's tricky, but it's a very important economy for Australia.
And looking ahead now, can you give us your outlook for earnings? You discussed it in the AGM, but then also touch on how that impacts your projections for different companies and their dividends.
Yeah, look, we're relatively negative, I think, on earnings. I think there's a few headwinds in the economy. So clearly, if you have debt, your interest cost is going up, regardless of how well you've hedged your debt. As you refinance, you're going to be having higher interest costs. I think the easy, price rises because of inflation we saw from a lot of providers. I mean, providers we use, people almost expected a price rise. Oh, inflation's high and we'll pass through. I think the next round of price rises will be more challenging, and we're still seeing costs rising. So if you get a slowing consumer and a slowing economy, businesses can't push through their price rises anymore, higher interest costs as well, and potentially decisions because of just the uncertainty in the world that maybe we want to carry a little bit less debt, so we then use some of our cash flow to pay down debt. You could easily see earnings probably miss to the downside, and if earnings miss, you would expect that dividends probably miss as well.
So increasing costs of capital, potentially a slowing economy, a more subdued consumer. What other factors are likely to be shaping the economy at a broad level? Any specific stocks as well?
Oh, look, it's a bit hard to say. I mean, at the end of the day, Australia is sort of a micro universe of what happens around the globe. We've got the US presidential election next year, and historically it's actually an up year for markets because no president wants to run in a recession or running into a recession. So the fiscal spend is high. Generally, markets do well. Having said that, we do have a heightened geopolitical tensions, and really no one knows what the next move may or may not be over the coming months. So that's clearly a risk, and particularly if energy prices accelerate from here, that's pretty inflationary, and that's going to be really hard to control. That would be negative because then central banks may be forced to put up rates just at a time when economies are sort of rolling over. That wouldn't be a great outcome. I mean, I think the Aussie economy is in relatively good shape. I mean, we have some corporates have debt, but they certainly don't have GFC debt. We have one of the highest population growths of any Western economy. We have, it's largely migration, of course, but still it's positive. So that leads to consumer spending, is making some challenges with housing, which is becoming a bit of a political issue. But we think of I guess, the investable economies, Australia is probably in relatively good shape. Not to say that if things happen across the world, I mean, we will certainly be impacted.
Any other specific factors or comments you wanted to make about the outlook?
Not really. I think it's interesting when in our speech earlier today, uncertain came up again. I think we started using uncertain through COVID, which was probably a soft word because COVID was a pretty wild time. But the markets have been pretty uncertain now for a while, and I think that's why there's less guidance from corporates out there because even though they're probably very good and they've got a lot of history, we haven't seen interest rates go up this quickly for 25, 40 years, depending on which economy. We probably haven't seen the geopolitical tensions, like real wars going on, in my working lifetime. So you overlay that and, the biggest growth engine of the world over the last 20 years has been China, which is now slowing. So putting that into the mix and you go, it is pretty uncertain. So, we're pretty conservative. We think there'll be volatility. We think there's still some good quality companies out there that may get more attractive to buy or have pretty resilient business models. But, we're also pretty cautious on, I guess, some of the more expensive parts of the market, which are as much about, the emotive side of investing as their earnings. And that could change pretty quickly. So we're in no rush to, fully deploy. We have some cash at the moment, but I think it's going to be another interesting few months. And we've got AGM season coming. There'll be a little bit of an update from some corporates. We've got the banking reporting season, which kicks off next week. They're a good read on the economy. Macquarie Bank will be a good read on what's happening with other markets. So, everyone, is hanging on the next bit of information, which investors are now institutional investors are now getting drip fed, as opposed to having a guidance number out there 12 months in advance. And you went, I think we like this management team, they'll hit their guidance. That was a fairly easy investing environment with fairly benign interest rates, inflation, and in some ways geopolitics as well. So it's all been turned on its head.
Certainly a dynamic and interesting investing environment. Thanks, Jason.